Let's also welcome on board Dinshaw Irani, CEO of Helios Mutual Fund. Hi, Dinshaw. Great to be speaking with you. Firstly, help us with your take on the markets, because the month gone by has been great for the Indian markets. At least the FIIs have made a comeback. The earnings, especially the kind of disappointment within the IT companies, the valuations were coming at the forefront and taking the seat, and investors seems to be liking it. But what's your overall mood on the market, given the fact that we have already seen a good run up from those March lows?
Very good morning, Shrishti, and a very good morning to all your viewers and your team. And thank you for having me on your show. So basically, Shrishti, the fact is that the FIs are back, right? I mean, last 2 weeks, they're pumped in something like $3.5–4 odd billion into the market. And that is and the flow is also very sustainable flow, because what happened was, I mean, if you look at the ETFs, which is your emerging market ETFs or India dedicated ETFs, they haven't seen much flows. So basically what this is hinting towards is that this is active money which is coming back. And I mean, surprisingly, this active money which is coming back. I mean, if you relate it to what's happened in the US debt ETFs have seen a lot of huge outflows. So basically, I think the money which moved out of India, and all along we've been saying that, we always felt that the money went back to the US because they were worried about valuations, about the rupee, and obviously about the fundamentals as such. So that money went back to US, parked itself there, and I think that's what's coming back in. And I think the fact is that US per se is now coming under the big question mark. I mean, the president, Mr. Donald Trump out there, has been backtracking a bit, and fortunately for the world as such, because he's, I think, more worried about the equity markets, and it's obvious because twice he's backtracked on big calls that he made in the market. One was obviously the tariffs. Once the market started collapsing, he had to backtrack. He gave a 90-day reprieve. Secondly, Mr. Jerome Powell, he's been after him, and when the markets went down, he backtracked on that. So I think there's some sense prevailing out there, but frankly, I mean, still too early to call it out. And secondly, the bigger problem is the India valuations. I mean, the quarter went by, I mean, which is now getting reported. You've seen the numbers. They're not that exciting numbers. And valuations, again, are feeling a bit stretched, because from now on, you'll see cuts in earnings as such, which is already happening. And most of the numbers that got reported saw a cut in earnings as such. So I think that's where the concern is. And frankly, I mean, we're just being a bit cautious, I suppose. We are fully invested, though. We hardly have some cash, 3–4% in a couple of funds, but otherwise we're fully invested. But in my long short, we are, I think, 61–62% net and ready to pull the trigger whenever there's a pullback.
Very good morning to you, Dinshaw. Like you said, that we've seen Trump actually easing it a bit on his rhetoric. Are you happy that this weekend you didn't have to wake up to some new rhetoric by him? Was it an easy Monday morning, at least so far for us?
Yeah, it was. But the India-Pakistan tension, I think that is yet to play out. I think there's something may happen, and maybe that'll impact the markets. But looking at the past, whenever these events have happened, the markets have only rallied up. I think our Indian markets are much more resilient to this. But now the only unfortunate part is the valuations. I think that is where the concern arises. And that's why, by the way, I don't know how many of you have noticed this, but there's been a constant selling by retail, I believe, in the market. And that's why the mid cap and small cap space has been fairly weak as compared to the large cap. The large caps are held up quite appreciably as such. And that's where the major cuts are happening, because IT, PAC, totally a disappointing set of numbers. I think basically there was a relief rally happened out there, but I don't think that's sustainable. So I think there's quite a bit of question marks right now.
Right, absolutely. The fact that you pointed out, yes, you are seeing some sort of a selling pressure coming, especially from the retail investors, no doubt. Month to date, you have a buy figure coming in from the FIIs. But yes, now that the fact that you have retail investors getting a bit jittery is a cause of concern. And excuse me, pardon me. And Dinshaw, like you mentioned, the valuations are a bit stretched. So where are you actually looking for value right now, given the fact that we've seen the sharp fall, then we've seen a rapid rise, and now you're struggling to actually go ahead and allocate funds, isn't it?
Yes, definitely, because we have our comfort zones. I mean, one big comfort zone for us has always been the financial, the BFSI space as such. And you've seen the results out there. If anything, they've been fairly, I mean, apart from the microfinance and some of the NBFCs reporting disappointing numbers. But I think the bulk of the reportage from that particular segment has been fairly strong. I think that's one area that we were very comfortable with. Secondly, a set of numbers yet to be reported are by the hotel sector, the hospitality sector. I think that is going to be a surprise, because if you look at if you're tracking that sector on the ARR basis and on the ARPOB basis, they've been fairly exciting. I mean, the numbers are fairly high YOY also. Having talked about hospitality, let's talk about hospital, the healthcare sector. Again, that's another area that we're very comfortable with. I think that's going to report very good numbers going forward. So I think these are the specific areas that we are comfortable with, and I think that's where we're trying to park our money, given that the way the world is today.
Well, but help us understand that which are the pockets that are not looking that great to you, because I just can't get over the fact that at a point when Tata Motors was hitting around 1,000 rupees, you guys came ahead and made a short call on not just Tata Motors, but the overall auto space was not looking that exciting to you. At this point in time, when you are having a cautious stance on the market, which sectors are you betting big on?
So basically, again, I mean, on the cautious side, rather on the negative side, we remain negative on an auto space. You saw the numbers from Maruti. You heard the commentary from the management. The only space that looks good right now, I mean, in the auto space, is probably the SUV space, and unfortunately, that's what US is targeting for India. I mean, that's where they want to send their cars in as such, and at zero duties and stuff like that. So that will create a lot of competition going forward. So I think that space looks fairly unexciting today. EV has been a big disruptor anyways in that space. The second space that we don't like and have been negative for the last probably 2-3 months is probably IT. IT again, except some pockets here and there, I think that is going to be a major sufferer of what's happening in the US. If there's a slowdown building in, and that's what the world is betting on today. I mean, if you look at the way the bond markets have been reacting in the US, it's obvious that they're looking at a slowdown going forward. And if that happens, IT is a big loser, because that's their biggest clientele, the US markets as such. So that's one space. And secondly, I think AI will play a big role in disrupting the existing model of IT. So I think that's another reason why we are so negative on IT today. So better stay away from that. Certain pockets within consumer space, like paints and all, I think we don't believe that this kind of growth can, I mean, rather not even growth, the fact that the rally that happened in the paint space, I don't think that's going to sustain given the way the dynamics of the Indian economy are today. So these are a few areas, and FMCG obviously, where the valuations are again stretched. There was some amount of up trading happening, but that also stopped. So I don't think that area is looking good. So these are a few areas that we are very cautious about.
Right. So those are some of the areas that you're not liking at this point in time, Dinshaw. But among all of these names, either on the positive side or from the negative side, I didn't hear about the word. I didn't hear the word power. What's your view on the entire power space, given that it's a big theme and it's a multi-year theme that everyone's been betting on? What about you? What's your view on the power space?
I think bullish on power, but the unfortunate part is there are hardly any plays to play it out with. There are a few derivatives that we played out with. You can see it in our portfolio whenever you open it, and obviously the main utility plays, there's only one or two which are fairly appealing. So that's the only reason. And frankly, I mean, that's not a mover as such, because in the index that's not got too much of a weight. I think that space is going to outperform. But again, as I said, that only a handful of stocks which are looking appealing out there in terms of valuations. Others are looking fairly stretched. We are fairly bullish on that segment. And you've seen that. I mean, look at the heat wave, which is going across the country as such. I think that's one area. And when you see the peak to trough rates in power, which are seen on the exchanges, it's giving a clear indicator that at the peak levels, we are totally having no capacity to meet that demand. So it's a matter of time before things work out.
Good morning. I'm joining slightly late today.
Sorry, Nikunj, I didn't catch that.
No, I'm joining late today. You didn't ask anybody where's Nikunj.
No, I was wondering.
No. What is this?
And you didn't come into my glasses on either. So
they are old now. They're old now. So these are magical glasses. When you wore them, market started going up. Please wear them during the sleep also.
They're still working a bit.
So what are the magical glasses telling us? Which is the next big one to buy now? Next big stock or sector to buy? Look into your magical glasses. You have a reputation now.
Yeah, I wish my glasses could tell me that and be a bit of a crystal ball kind of thing. But anyway, I don't think there are any big sectors today. I think the biggest call out here today is to conserve money. And that's what we're looking at. We are very, 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 I would say, cautious in the market today. As I said that though we are fully invested, but we know that things are not working out too well. Frankly, I mean, our feel was, by the way, one big caveat is if the US back off on the tariff war, I think things will start looking back again, probably in the December quarter. Earlier, our feel was that September quarter will see some uptick happening, but now it looks more like a December quarter thing. So a couple of quarters are going to be very trying, very testing. We're not taking any new bets out here. We are sticking to our old war horses that we've been betting on for a while. So I think I'll stop here.
Today, we are breathing and everybody's taking a sigh of relief, and the market action has been more than a breath of fresh air because gains have been quite impressive. But what happens after this so-called 90-day window? I mean, it's a lifeline and it's a time which is ticking. What should be a best strategy to approach this 90-day window? Because 90-day markets are safe. The 91st day is when everything will be out in the open.
Right. So Nikunj, actually, one thing that I took away from the actions of the president, the US president, was that he's very concerned about the markets. He's been backtracking on his calls and his aggressiveness whenever he's seen the market collapsing. He stood his ground for tariffs for a very long time, till the time he realized that even the bond markets were now, getting into default territory as such. I mean, the auctions were devolving. So I think that's what turned him around a bit. So he's still, and you saw what happened in the case of Jerome Powell. The moment he started targeting the fellow, the market started collapsing and he had to backtrack. He said, no intentions of making move out. He'll remain till his tenor, which is in May 26th, I think, up to then. So basically, the fact is he's very sensitive to the market. So that's one thing positive that I take away from the whole action. And our belief is that even when they've now come out and stated that, look, we're talking to China too, and China's been denying that. So it shows the desperation on the part of the US, by the way, that they're saying that we're talking to them and China saying we're not talking to them. So it's obvious that they want the world to come back to some semblance. Probably the world will have to live with probably a 10% kind of tariffs, which again is high. I mean, as compared to 3.3 that they had prior to Trump starting his tirade, coming to 10%, still fairly high. But I think it's a win-win for the world as such. And maybe that is what the world can live with. That's why I said that probably from September onwards, when things start, not from September, sorry, December quarter onwards, when things starts getting a bit more stable, then you can take a call on the markets and say, okay, now things are on an even keel. Let's look at the markets and let's start taking our bets more aggressively.
So Dinshaw, let's understand what to do and what not to do in this market. What has happened in last couple of days is banks. Everybody was positioning for a move in banks and that move has happened. Are banks now getting priced to perfection? Can they move from outperformer to market performer or even underperformer now?
So basically, Nikunj, look at it this way. As I said in the beginning, I think basically the FII money which has come back, this is much more active money which has come back in the market. And I mean, buying $3.5 billion in the last 2 weeks is not a small amount at all. It's a fairly huge sum. And basically, our feel is that they came back into the stocks which they sold, and they were heavy sellers in no doubt in the banking space, and that's what they bought back again. Even today, despite that massive buying from FIIs, I don't think the banking space is looking that stretched on valuations. They had gone down quite appreciably. Even today, at 2+ kind of book value for the frontline banks, it's not looking too stretched given the fact that things are now picking up. The only concern that the banking sector had earlier also, the way the liquidity was getting constrained from the system. With the new governor coming in at RBI, I think his mandate is quite clear: get the demand back into the system, get infuse liquidity. In fact, in the last couple of weeks after the 15th March crunch that one saw because of taxations and all that, advanced taxes and all that, there's been a total surplus, 1 lakh plus crores kind of surplus in the system. So I think that's what is helping the banking system going forward. If demand does come back, these are the guys you want to play with. And frankly, our belief is that the rally that you saw may be just a beginning of, frankly, our feel is that this is the sector which will prop up the markets for a fairly long time.
That's the take coming in on markets and especially on the banks, given the fact that we've seen a sharp run up, a lot of interest actually coming into the banking space. But on that note, thank you so much, Dinshaw, for joining us on ET Now to talk about where you're deploying cash, where you're not deploying cash, and what's your view on the markets, and especially the Trump rhetoric. Thank you so much for being part this morning. If you look at the
It's a pleasure to be on the show.
If you like this video, then like, share and subscribe to ET Now.